Supermicro is a middleman. It assembles other people's award-winning GPUs into racks, integrates cooling systems, validates firmware, and ships the whole unit to hyperscalers and enterprises. That business model is volume-driven, and volume has always meant thin gross margins. Think 10% to 15% gross profit range. That slice of a giant pie doesn't guarantee fat profits or healthy cash flow. If every dollar in revenue only leaves you a dime or two for covering SG&A, R&D, interest, and capital investments, the balance sheet starts looking precarious when anything goes wrong. Looks cheap by revenue? Sure. But cheap is a warning, not a promise. Let's stare at the glaring facts, not the marketing slides. Revenue trajectory. After hypergrowth during the AI infrastructure surge, the top line has been massive, but the latest quarter showed $5.0 billion in revenue, down from $5.9 billion year-over-year. Management still points to a huge backlog and is guiding $4.10, $11 billion in the next quarter. That's not a misprint. They expect a possible quarter-over-quarter doubling if backlog converts on time. That's blockbuster potential, but it's timing sensitive. Margins. Gross profit in the quarter was under $500 million, translating to a 9% gross margin, meaning the company kept less than a dime per revenue dollar. Last year it hovered closer to 13%, so that's a meaningful squeeze. Lower margins mean less wiggle room for mistakes. Profit and valuation. Trailing 12-month net income clocks in just under $800 million, implying a trailing P/E near 24 at the $18 billion market cap. At first glance, that P/E looks reasonable, particularly given the revenue growth narrative, but a deep dive into cash flow tells a different story. Cash flow. Alarm bells. The company burned nearly $918 million in operating cash in the quarter, one of the data points you gave. That's not a small operational hiccup, it's a red spotlight. Even with $4.2 billion of cash on the balance sheet, the burn rate matters. If cash flow continues to flip between positive and negative each quarter, the company may soon need to raise capital, by debt or equity, both of which dilute or squeeze investors. Debt. Net debt of roughly $575 million, i.e., $4.8 billion debt versus $4.2 billion cash, after a prior net cash position is another nagging issue, especially when a large portion is convertible notes that can dilute shareholders later. That jump in leverage is an eyebrow raiser. You can almost hear the trading desk, revenues v huge, margins v thin, cash v burning. Roll the highlight reel and then hold the phone. By the way, if you are benefiting from the content so far and want more like this, like the video, it means much to me, or hit the subscribe button and comment the word more. Just go ahead and type the word more so I know. Now that you have commented, let's continue. Why margins matter, the arithmetic of thin slices. I'll put this in dinner table terms. Imagine you run a pizza place that sells $36 of pizza each minute. Sounds amazing, right? But if your ingredients, rent, and staff cost you $33, you only keep $3. That $3 has to cover everything else: loan interest, unexpected ovens breaking, the marketing guy who does TikToks, and the CEO's tie collection. If anything spikes, flour costs, oven repairs, you're toast. Supermicro's pizza is massive, billions of slices, but management only keeps a thin margin per slice. That means, small cost increases, memory, networking silicon, specialized connectors, can wipe out profitability quickly. Price concessions to hyperscalers, who can demand huge discounts, compress margins even further. Integration and warranty costs for complex racks, which are tricky to ship, can add overhead that management didn't plan for. So, even a quarter of blockbuster revenue can leave investors unimpressed if margins don't stabilize. Can management turn the margin engine back on before the cash burns the runway? Customer concentration, when 3 customers become the story. Here's one of those structural things that investors love to whisper about at parties: customer concentration. In Supermicro's case, a very small number of customers represent a large share of accounts receivable and revenue. The data you provided flagged 3 customers representing significant portions of outstanding receivables, numbers like 29%, 19.7%, 12% in your text. Why this matters: if one giant customer delays payment, pushes out a fleet of racks, or renegotiates, the company's quarter can look suddenly empty. You can't easily replace that kind of order volume overnight. For a company with thin margins and chunky capex needs, that's a volatility multiplier. It's like being a bakery that supplies croissants to 3 mega hotel chains. If one hotel delays contracts for a season, your oven's idle and your bakers still want paychecks. Not fun. Backlog versus recognized revenue. Orders are not sales until accepted. This is the classic orders versus revenue trap. Supermicro boasts a huge backlog, billions of dollars of orders for NVIDIA Blackwell-class racks and similar systems. That backlog is the reason management has the confidence to guide toward $33 to $36 billion in FY26. But here's the accounting soap opera: orders only become revenue when systems ship and customers accept them. Complex GPU racks require co-engineering, compatibility testing, thermal validation, and acceptance certificates. Those steps often take weeks or months. If customers delay acceptance, because they want the next GPU, or because their own pilots haven't finished, the revenue recognition slips quarter to quarter. Remember the headlines about CoreWeave and a few other neoclouds? When a cloud provider stumbles, cash strain, debt raises, or execution issues, investors suddenly ask if the AI infrastructure boom is real or financially fragile. Those stories ripple upstream. Suppliers like Supermicro get hit because delinquencies or order cancellations are immediate and public. If a wave of cloud operators defaults or pauses growth, demand for new racks will fall, and who is left holding the assembled but unsold racks? The integrator. That's Supermicro. The risk is not theoretical. The market's December reaction, a sharp share price decline, was the emotional response to that exact scenario. Wall Street is schizophrenic about Supermicro. The coverage you cited shows 17 to 19 analysts with a wide target range, low of $15 to high of $93, median closer to $48. Some houses are cautious. Goldman kept a sell, while others remain constructive. The spread is huge. That's a sign the story is binary: either the backlog turns into clean revenue plus margin recovery, or the company stumbles into a capital-raising, margin-compressed slog. Simple rule of thumb: when analysts disagree that violently, you're dealing with a stock that will swing violently, too. If you crave adrenaline, great. If you crave sleep, maybe not. Note this as well. Do you want peace at heart? The next day John seeth Jesus coming unto him, and saith, Behold the Lamb of God, which taketh away the sin of the world. John 1:29. Fear God, and give glory to him, for the hour of his judgment is come, and worship him that made heaven, and earth, and the sea, and the fountains of waters. Revelation 14 verse 7. I appeal to you to fear God and obey his law. For his commandments are sure and his word everlasting. Do not be afraid, do not be discouraged. Want more information? Please check the description section. That's the end for now. If you have watched until the end, drop a comment like this: I stayed until the end. Just comment that I stayed until the end. When I see this comment, I will give you a heart. 3 more favors I request from you. First, like this video, subscribe and then turn on the notifications bell. If you do this, you greatly encourage me to continue bringing to you insightful information. Do not miss out on our future videos full of insight. All I am asking is your subscription. Thanks for joining us today. Your support means so much to us. Do not hesitate to share this video to help someone who may benefit. I recommend that you watch the next video, subscribe to the channel and share your thoughts about today's video. Wish you God's blessings and care. Wait, watch and pray. See you in the next video according to God's will.